There's been a lot of talk about millionaires, billionaires, wealth taxes, and paying your fair share recently. Something you'll hear a lot in these discussions is the term net worth. This video is going to explain everything you need to know about net worth. This includes how net worth works, why it's important, and how you can calculate your net worth. If that sounds good, make sure to click that like button to increase this video's net worth and importance within the YouTube algorithm. While you're down there, please also subscribe and ring the bell to be notified when new videos come out every Friday. They'll help you live a life you love through personal finance and self-improvement. Net worth is the mathematical difference between your total assets and your total liabilities. This is essentially how much you own versus what you owe. This concept can be applied to both people like you and me or entire companies and corporations. Net worth is important because it's an easy way to track something's financial health or its financial position over time. This can also be applied to companies that you're running or ones that you'd like to invest in. The higher your business's or a company's net worth, the better their financial situation on average. To explain why and define situations in which a high net worth may also still be a cause for concern, let's look a little deeper into the definition. Very simply, net worth is total assets minus total liabilities. Assets are anything that have value. Liabilities are any form of debt or owed money. Common example of assets would be cash, property, and investments like stocks and bonds. When we talk about net worth, this money is going to be shown in dollars. Things like investments change in value over time. Therefore, net worth calculations are taken based on the specific valuation of those assets at a given time. One example would be a company's balance sheet. This shows a company's value on paper based on all of their assets and liabilities at a specific point in time, typically the end of the quarter or the end of the year. Let's say we're looking at somebody's net worth today. They could be doing great because one of their investments, like into Squid Game crypto, just went to the moon. The next day when we look at their net worth, it could be a lot lower, such as if that investment was just a big scam. So just having a high net worth may not be a surefire indicator of financial health. It depends on what kind of assets you own and, more importantly, whether or not this net worth can be sustained over time. So how do you go about sustaining and increasing your net worth? There are two answers, and to understand them we have to look at liabilities first. Liabilities are an obligation to pay back a debt. Think of any loan, such as your car payments, student loans, or even a mortgage. Liabilities would also include things like IOUs to your friends or money not yet paid for a good delivered or a service performed. Think about contractors who don't get fully paid until they're finished. Whoever's paying them has a liability to pay them sometime in the future. But in our personal finance space, liabilities are going to mostly be common forms of debt. So now going back to the net worth equation, we can see that the answer to sustaining and then growing your net worth over time is going to be either to increase your assets or to decrease your liabilities. Let's start with increasing your assets. Because this number is expressed in dollars, it can be easy to say that the answer is just to make more money. That will help, but we have to think a little bit bigger picture. When you make more money, you get paid in more cash. This cash is an asset, and thus it's going to increase your net worth. However, simply having more cash is actually going to lose you value over time due to inflation. This is the decrease in your money's purchasing power over time as it becomes less scarce or less rare. While the amount of money you have in your bank account will stay the same, it will be able to buy you less amount of stuff in the future than it can now. So we need our money to grow faster than the rate of inflation to maintain at least the real value of our net worth over time. Real means that we're adjusting dollars from different time periods to account for inflation. Doing just dollars to dollars would be called the nominal value. The best way to outpace inflation is to invest your money. Typically, the inflation target in the United States is 2 to 3% per year. The stock market generates 8 to 10% return on average per year. This means that investing in the stock market can net you a 5 to 8% real return on your money every year. As stock prices increase, so will your assets column in the net value equation, then stocks are simply an asset. And based on historical data, these assets will grow faster than the inflation rate, meaning that you'll be worth even more in real money over time. But as I mentioned earlier, net worth is a snapshot of your financial value at a moment in time. Simply investing in stocks isn't a one-size-fits-all solution because, like all investments, they can also go down. The market just crashes from time to time, and there's just simply no way to predict when this is going to happen. Now, historically, stocks always recover if you give it enough time, assuming we're talking about the whole market and not an individual company. This is why you need to know that the most important thing about your net worth is going to be its trend over time. Is it increasing, decreasing, or basically just staying the same? Obviously, we all want to see it increasing. Now, your assets include many things beyond just cash and investments. A popular example would be property. Every time you make a mortgage or a car payment, you own another piece or percentage of that property that you've bought. This is known as equity. The more equity or ownership of an asset that you have, the higher that your net worth is going to be. And the cool thing with owning houses and real estate is that their value also typically tends to go up over time. This value appreciation is also included in equity. If your property's value increases at a rate that's higher than the interest rate on your loan, your net worth will get a boost on both the increase of your equity and the price appreciation of the asset. Real estate is a popular asset when talking about net worth because you can buy it and then rent it out to other people. If you pay somebody else to take care of this process for you, then you'll be generating passive income. This hot buzzword means any money that you make for little to no effort. But of course, that's just the goal of investing. Your money grows over time by just putting your money into the stock market. Your best bet is broad market index funds. But there's a difference between this passive price appreciation and then the passive collection of rents. This difference is well wealth versus income. Wealth is your net worth. It's the things that you own and how valuable they are. Income is money that you make, typically from selling a good or a service. The Finance Guru is online, and the concept of passive income is more so focused on the second part. Putting in little effort but still getting a paycheck every now and again, passive income. But doing this part is hard and actually requires a lot of active effort. Building a business, writing a book, or selling a course are all hands-on active projects that have big risks associated with them. Once your business is running, there's no guarantee that it's successful. If you write a book or make a course, it's most likely that few people buy it because you likely don't have a large receptive audience to sell to. You can learn more about that and what they don't tell you about passive income in a video linked in the description. The important part is that it actually takes a lot of active, risky work and requires a lot of money to get started in order to make any kind of substantial passive income. This is the beauty of investing. It can generate passive income for you in terms of growing your wealth over time, and it makes you the normal kind of passive income through things like bond, coupon payments, stock dividends, or crypto lending yields. Plus, it's much simpler and can be a lot less risky to do versus starting, running, and then paying somebody else to take care of your business. Of course, the additional risk for making your own business can also lead to greater rewards. It's just difficult and may not be the path for everyone despite what you hear online. Now let's look at the other half of your net worth equation, the liabilities. I think it's intuitive how you decrease your liabilities. You pay down your debts. However, this ignores the fact that having debt can actually increase your net worth in the long run. For example, many people take out student loans in order to earn a degree which they think can increase their earnings potential over time. This extra cash that you earn can also be invested, thus increasing your net worth even more over time as this value appreciates. The same principle can be true of real estate investments and other business loans. The common type of debt that you might have that won't generate value for you is going to be your car payment. Vehicles lose value or depreciate over time, and this is the opposite of what we want to see for our assets. However, putting extra money toward paying off your auto loan sooner than necessary may actually hurt you in the long run. This is because of the opportunity cost associated with not investing that money into something that's going to earn you a higher interest rate than the interest rate of your auto loan. For more information on that and the impact of paying off your loans early on your credit score, there's another cool video you can check out in the description. In short, you'll actually want to make minimum interest payments on your debt so long as they're less than something like 8%. Debt can also help you finance large purchases like real estate investments or other types of business loans. It's more important to think about the long-term value that debt can generate for you versus its immediate impact on your net worth. So how can you calculate your net worth? Very simply, you add up all of your assets and then subtract all of your liabilities. But that's easier said than done, right? Mint is one popular tool. This will help you track your various online accounts and other property to show how your net worth changes over time. I've also got a good video about that linked in the description. Otherwise, you can set up a good old-fashioned spreadsheet, though this requires a lot more effort and you're also going to have to update it more often. And that's because it's not going to be automatic, unlike Mint or other similar apps. It will be easier for you to start with your liabilities because there's probably going to be fewer of these as compared to the amount of assets that you own. Sum up the remaining value of all of your different loans, student, car, house, etc., and then that's your total liabilities. For assets, this is going to be more involved. Start with obvious things like your bank account, cash on hand, Venmo or PayPal balances, various investment accounts, crypto wallets, and so on. The tricky part will be your physical assets. Things such as collections or expensive equipment like cameras can be hard to value. The rule of thumb is to price them at a fair market value based on their going rate on the secondhand market on a platform such as eBay. You shouldn't include everything that you own. The idea is to include everything that is definitely valuable or has some liquidity. Liquidity is the amount of ease that an asset can be exchanged for or sold for cash. Common stocks are highly liquid, for example, because there's so many buyers out there. Cash is the most liquid thing there is since everybody uses it and needs it. In contrast, real estate is actually illiquid since it takes a while to sell despite it being valuable. Your assets column in the net worth equation may not ever be 100% accurate because it's very tough to list out everything that you own that's valuable enough or easy enough to sell to be included. The important assets will be your cash, investments, electronics, professional equipment, and however much principal you own in terms of real estate and your vehicles. Sum all those up and now you've got your total assets estimate. Finally, take your total assets and subtract your total liabilities, and there you go, you've got your net worth. If you have a negative net worth, you don't necessarily need to worry about that right now. A lot of young people are going to have negative net worths due to student loans. I mean, I'm in the hole myself. And that's why I'm consistently investing and trying to find new ways to make more money. Also, make sure to like this video if you enjoyed it or learned something valuable. Subscribe and ring the bell to be notified if you'd like to follow along with my journey to a positive net worth. Click the video on screen to watch another that you're going to enjoy, and then please add some music, a positive net worth, or whatever else it is that you love to your day.